So number one, we're talking about market movement and beginner's guide. Tripod of trading. I'm going to theoretically explain it. Self-management, that is about yourself, which has to do with your psychology. You must work on it very, very well, consciously on a daily basis, reviewing things, videos that teaches much about psychology. Understand yourself as much as possible and tell yourself the truth. Be disciplined, work on yourself, destroy, this problem of fear. How do you destroy that? You have to make decision and stand by it. And the best decision is that it proceeds to money management. The money management has to do with risk management kind of a thing. And the best risk management is ascertained when somebody has able to develop his psychology appropriately. So when you work on your psychology, you're able to work on money management. So there are different tools on your trading view that you use, just like risk reward ratio and all the like. And of course, exposing how much amount of money can I afford to lose for the day. Risk reward ratio is segment of how much I can lose for the day. Okay. So for instance, you are trading with $1,000. For instance, that's why I love some of those prop firms. It will discipline you. Now, your prop firm, look at it. You are trading, you are giving an account of $10,000. Let me use an example of 10 trade. You are using an account of $10,000. And 10 trade told you that this account is a challenge account or irrespective condition account. And they said maximum drawdown is 8%. So 8% so you look at 8% of $10,000. If you look at it this way, so money management. So $10,000 is actually the fund that's available. So 8% of it, let's go this way, 8%. So of that, so 8% would be $800. That's number one. And they say daily drawdown is 6%. 6% would be $600. That would be very stupid of you to say, I can afford to lose $600 for the day. What's your target for losing $600 for the day? So now you move on to say, okay, I am not the whole money I can afford to be doing trading with anyhow. Just make it to be $800. So you are now telling yourself, I'm applying risk management on $800 and not $10,000. All right. So I'm applying risk management on $800 and not $10,000. Now, the point is this: even if there are issues, then I know that I still have backup that will fill it for me. So $800, if I'm trading with $800, what should be my exposure? Now, don't work with percentage. They will say 1% of your equity. No, it's not correct. Say 1% of your equity. Persons who is trading with 200,000, 1% of his equity is $2,000. So can he say, I can afford to lose 2,000 for the day? No. So now you are going to work out the modality. Okay, $800. How much can I expose to my trade? If I'm trading with $800, you now come to the daily exposure, $600. So you can divide $600 into 6. So you say $100. If I lose up to $100 for today on this account, I'm done. If I lose $100 today on this account, I'm done. So that $100 now can be exposed in different risk reward. So you now go, every trade you want to take, you have first of all calculated how much, about $100 set aside as what you can afford to lose for the day. Now, when you are entering a trade, your risk reward ratio, normally we talk about 1:2, okay? So if that is the case, you are working with $100 that can afford to be lost for today, $100. Now, so you now ask me, sir, what if I'm trading with only $100? How much will I afford to lose? Then percentage can be applied. Perhaps you can afford to say, okay, for today, I can afford to lose $20 off my $100. Now, this $20 is not going to be exposed to the market at a go. So that means, so this $100 now that I want to expose, now, am I going to expose it at a go? No, you are not going by this. Each trade I'm going to take risk reward. So I can afford to lose. So trading to say, okay, maybe $10 to make $20 or $15 to make $30. So if that is the case, that means you are going to work this way. You now enter a trade. Your stop loss should be within that range that's going to give dollar value of this. Let's take, for instance, you are going to enter gold and you plot your risk reward ratio, and you are seeing you are having maybe, let's say maybe you are having up to 15, 10, 15, 20, 30 pips as your stop loss. Now, and you are using 0.01. So if you multiply 0.01, so you are going to say 0.01 multiplied by 30 pips. Okay, sorry. 0.01. Am I correct? Something like that. Multiplied by 30. No, not multiplied by 30 pips. Sorry. You know, this is Forex. This is not synthetics. This is not the point. Every pips in Forex have a dollar value. So you start from one standard lot. So one standard lot, the dollar value of one standard lot is $10. Okay? If you don't know how to calculate pips. So one lot is equals to, so one lot is actually equal to $10. So you can work your calculation. If one lot is cost to $10, that means 0.5 is $5. Okay? 0.5 is $5. 0.1 is $1. Are you getting it now? 0.1 is $1. If 0.1 is $1, that means 0.05 is 50 cents. If 0.05 is 50 cents, then 0.01 is 10 cents. So that's to say, if I can afford to lose 15 or 30 pips, so your 30 pips multiplied by 0.1. Okay, this is the cent. And then you arrive at how much? So 0.1 multiplied by 30. That is $3. So that means if you are a swing trader or depending, that means if you are trading with small amount, you are supposed to be using this. But I can tell you that gold can drop down to 50 pips. So if it's 50 pips, because you are targeting 100 pips, so that means 50 multiplied by 0.1. That's going to give you $5. So losing $5 to make $10. So you must do all of this. These are your calculation for you to trade, because you should be able to know how much you are about to lose because you know how much you wanted to make. All right? So if it's 100 pips, that is your stop loss. So you calculate what is the lot size you're using. So if your stop loss is 50 cents and you are using 0.1, that means this is $50. As soon as the market hits your stop loss, you have lost $50. Now, if you are using 0.05, so at 50 pips, you are losing $25. So if you are using 0.02, so that is 20 cents multiplied by 50 pips. Okay, so let's do the calculation. 50 multiplied by 0.2. That should be $20, if I'm not mistaken. Sorry. 0.2. Oh, yeah. Multiply by 50. Okay, $10. So now you that have afford to say, okay, I can afford to lose $10 per trade, even if the market go to 50 pips. But this is the challenge. You can further divide it into two. Okay, so you see this thing now, you can further divide into 2 or 3 or 4 or 5. So this trade, if I can afford to lose $10 on this trade, because I want to make $50, I want to make $20. Now I can enter this trade twice or 3 times, depending. So you are taking the average. But to be very calculative, first of all, you have said, okay, 50 pips is the drawdown I can afford on stop loss. in order to make 100 pips. So you have to see where the market is at that time to be able to do all of this. So this is a must. So self-management, your psychology, discipline, what you have said. And the second is the money management, which has to do with risk. And once you have traded like this, and in a day you are losing and losing and losing, and you see that you have wasted about $100 out of your, because that was your calculation, stop trading for that day. So market behavior, you can manage market, but learn to understand the behavior. So this is the summary, SMM. Now, markets, if I must understand market behavior, markets have phases: contraction, expansion, and delivery. What SMC call accumulation, manipulation, and distribution, stuff like that. Okay, because AMD, accumulation, manipulation, or mitigation, or whatever, and then distribution. So I call it contraction, expansion, and delivery. So screenshot these 10 trading magic for beginner. So these are the 10 things we are going to do now, and then we jump into trade. Top-down analysis, key levels. I have training on this separately. So this is, I'm just giving a kind of executive summary for you to have an idea for everyone who are going to be trading with us, either Forex, synthetics, anything. So top, call it 10, what do we call it? 10 trading magic, okay? Because we need to see it properly. So let's take it down here. So you can screenshot this. 10 trading magic. 10 trading magic for beginner. Okay? 10 trading magic for beginner. You can just screenshot it. Okay, if you have screenshot it, so let's go. 10 trading magic, but there's a tips I give here. Beginner trading strategy. We are going to be using support and resistance strategy. So we're going to be using support and resistance. Okay, so we're going to be using support and resistance strategy. Now, take note that it doesn't matter which market. This strategy applies to all markets. Either you are trading spot or futures or crypto, future, even low gems, anyone, support and resistance strategy. There are many strategies, but this can be easily understood by anyone. So beginners trading strategies, we're going to be using support and resistance strategy. We say tips. Always DCA, understand the power of dollar cost average. Then work on 1:2 risk reward, and then maintain 5 fingers in the radar. What do we mean? When you are going to be trading that Forex future, whatever, have just 5 instruments in your radar. How many? 5 instruments. 5 instruments. Exactly those people who are trading futures, synthetics, Forex, 5 instruments in your radar, but perfect your strategy in taking 1 instrument per session. That's when you can maintain standard. You know, this jumping around, moving to this structure and all of that will actually disturb you. So we'll say 1 instrument per trading section. So now let's quickly go. Top-down analysis. So we're going to chart. Now, but you know this is Forex. There are basic things that are required of you because this is Forex. And what is required of is very simple. There's something very, very significant that is required of you, which is very simple. However, there are trading timing that we always recommend for people so that you can maximize a high profitability. These are different training altogether that I'll actually give separately, right? These are different trainings altogether if you must learn in all of this. So, but now let's go. So, since trading involves 3 analysis, 1, fundamental, 2, sentiment, and of course, that's where you need Forex Factory. Every day you wake up, you want to go to the Forex Factory. Are there new economic news that we're expecting for the day? Because it will affect your setup, okay? It has a way of affecting setup, either to disrupt it or to boost it. So, for instance, I'm checking this. Today is 18th of February 2025. Now, I want to, the one most people will pay attention on is any news that has to do with dollar. Now, there is no important major news that are related to dollar today. And how do I know? All this envelope, anyone that is red is an important news. But if you are the type that trade, perhaps you trade GBP, you may want to see what actually going to happen on this. Okay, if you check all those news on GBP, look at it. Look at this one that has happened. And they said actual less than forecast is good for the currency. That is, if it's higher, it's bad. Now, it is higher. That means you are going to see GBP actually reacting. So when GBP is paired with any currency that you are trading, maybe you are trading GBP, JPY, and then you have seen this news against GBP, you now go and check GPY, all right? Another one here was this. Now, if you go and check, so that will take you to the next instrument called currency method, right? Currency strength method. Now, maybe after the news, the guy actually got up because the second news was bullish. Now, if I have gotten any fundamental news, even before I check my technical, I've checked any fundamental news against, and I see that GBP is trending while the JPY is weak. Even GBP SND. So you can see these two currencies, they are weak. Why this one is strong? Why this one is strong? Even dollar is strong. That means USD JPY should be selling massively. USD SND, all right, should be, this should be buying. USD JPY, USD SND, or SND USD, something like that. Then GBP JPY, GBP SND should be buying. Then Euro USD. So Euro USD, so it's supposed to be pressing down, but Euro is now struggling to make up again. And that was why we saw what was happening and all of that. Now, so let's just experiment based on these. Maybe that's why I said the time we take to analyze the market is different from the time we take to trade. So, but I don't trade all instruments. So, especially currency in instrument. So let me take GBP SND, perhaps, if I can see something like that. GBP SND. Okay, that is pounds and New Zealand, whatever. Okay, so I'm going to go to that. And now, so now let's say this is the instrument. So you can see that it's actually bullish. Now, what we said, first you must understand is your top-down analysis. Okay? First, we say you must understand is your top-down analysis. I'm not going detail in this training, right? Just for us to be on the same page is why I'm doing this. I'm doing this just of all of us to be on the same page. My top-down analysis is to identify key levels and daily bias. Okay, now I'm going to go to so in TradingView, mostly that's why I recommend that you don't trade more than few instruments. It's very, very important. You don't trade more than few instruments. So let's say GBP SND. Now, my top-down analysis is simple. I will first do my mapping, but you don't do mapping every day. That's why you maintain few instruments. You don't need to do mapping every day. Okay? Now, to do mapping, I'm quickly going to go to my candlestick and I change it to a line chart. Now, when I change it to a line chart, I'm going to draw a zone, but to make it faster, I don't want to waste too much time. I'm going to use horizontal line. And then the horizontal line, you can see this is the roof. And then, of course, I love to make it thicker. And then I go again, probably just go to the floor. So I go to the floor. Now, next, I'm going to look at another important point, which is here. We have touch point, we have touch point here. That makes sense. Now, I'm going to take the candle again. Let's see. This is another point. This is a touch point here. There's a touch point here. There's a touch point here. Now, I'm going to take it again. And then let's locate this one. This one was obvious. And do we have more touch point? So there's a touch point here. There's a touch point here. So we don't need to put here because it can be assisted together. Now, we have another touch point here. So let's take this. So perhaps this seems to be, let's take, are we going to have more touch point? So I think this, because of the previous high here, make it very fantastic one and all of that. So you can just do the last one. I don't need to do too much. Remember, I just want to do just few things for us. So I'm taking to this point now. Okay. So now I'm done. So you ask me, this is my mapping. I return it back to candlestick. I return it back to candlestick. So to do top-down analysis, it is expected to be done from higher time frame to lower time frame. And remember what we said? What we said was that we want to do top-down analysis, and the first thing is that key levels, which is this. Now, you come for the day, and when you come for the day, you discover that the market actually was moving from here. So this was yesterday candle, and this is today's candle. So, of course, candlestick closes and open. So you are looking at how the candlestick got open and how the candlestick got closed. I'm doing this because it's going to be a record that, of course, everyone that new persons coming in are going to be watching to know basics of trading and, getting into the and pick whatever trade you want to use. Remember, the caution is that you don't trade too many instruments. You identify the instrument you can align with, and then you continue, because what you're looking for in a trade is volume. And then once you're able to identify volume, and then you identify the direction, so you are fine and to trade. So let's quickly go. Now, if I look at on daily candlestick, this candle closes yesterday bearish. Why this one closes bullish? But this is a kind of doji. Now, but please don't get it twisted. Most time people will just see doji and they want to look at the next thing that should open is that the market is bullish or is bearish. That's not a yardstick. You now need to see the formation of the new candle opening. Now, this candle, if you stretch it further, if you open it, even though, right, it first opened and went down below the close of yesterday, that gives you a bullish bias. Take note of it. Remember, the first thing we want to do is top-down analysis, key levels, daily bias. So that means if you have done your key level drawing, every day you just want to see the candle close and open to identify your bias. Then, the next thing you want to now pay attention to is what we call price action, which has to do with the candlestick and chart. Okay? It has to do with what? The candlestick and chart. Looking at this candlestick, it opens and went down. That is, we said to be like grab liquidity, then it's going to go. Remember what we said, that trade, the stages of the market is contraction, all right? First is contraction, and then we have what? Expansion and delivery. What the SMC call accumulation, manipulation, and distribution. So you have contraction, you have expansion and delivery. So it tends to be that irrespective of the timing, that when the market is still moving little by little, when there are no activities, then when it opens, it first go left. Now that it goes left, that's not the direction it wants to go. So once the market opens, all right, so this is what we're just explaining. Look at what we're explaining, and I'm sure we're going to learn a lot. Now, this is what market does. So market was, probably, okay, let's take up this. Okay. So markets actually open, yeah, okay. Okay, I need to be fast about this. So whatever it's doing, and then boom. Now, you would think that the market is going this direction. That is expansion. And then does what you want to do, and then boom, delivered. And of course, it is said to be that the market will now do that and return again back to this journey. Then it can do again another contraction, probably expansion, and then boom and delivery. Okay? Then continue again, and that's what market does. So when you wake up, what you want to do is to find where is market going to. And so you want to attend to your candlestick, right? So you must understand candle pattern, and so that you can be able to maximize your trade. Okay, so now we've come, let's say when you come, the market, this guy was already bullish. Now, the candle that opened matters. And we say candlestick had 4 components. First is we have the open, we have the close, we have the high, and we have the low. And of course, we have the body and the wick of the candle. So like this candle you see here, it has a wick. Some candle will open without any reasonable wick, unless you expand it very well before you can glance through the wick. So this candle open, right? It opened from here and first went up. That up we went to is the high, and it went down. This is the low, and it closes here. You can now see market open, and then contraction, expand, delivery, and then form another contraction. And that's what's going to repeat on the daily basis. Okay. Now, how do I know? Most time I tell people when I come, I just place my cursor on the candle. You can see up here. If I place my cursor on this candle, it will tell me the history of this candle. That this candle opened yesterday at 2.21345, and the highest it went yesterday 2.21487, and the lowest it went yesterday 2.19336, and it closes at 2.19615. Now, it was bearish because it has a negative of minus 0.01710. As simple as that, right? But this guy has not closed for today. This is guy yesterday where it opens, and of course, this is a doji. All right, this is a doji candle. So now let's go. Very okay. Now, for today, I haven't discovered this. I want to be looking for buying position. Now, let's go. I'm going to go to 4 hours. Now, in 4 hours, what 4 hours does for me and you here, okay? What 4 hours does for me and you here is that, and I normally make use of what we call trading session. That's session break. So if you go to 4 hours, you right click on your screen and go to event or whatever. Some may be canvas, and then you click on session break so that every day as I come, I can see where the market actually pop open and do the needful. Okay. So now, haven't seen this. You see now, your key level you have drawn have helped you. For the fact that the market opened here, I expect that this market to continue to this key level because it started from here. Not yesterday, not today, but the previous day. Then I want to see the continuation. However, for the fact that you want a continuation does not mean, because why I can assure you that this will continue, there's still another thing we learn. On looking at these 4 hours, it was consistently bearish. So I expect I expect it to be mitigated before probably going down or continue to go up, because that's what it has done here. All right. So this is a mitigation. So it needs to be mitigated. Even if a lower time frame, that's what it does. That's what market does. So now you have seen the 4 hours. Fortunately for you, you are seeing that, oh, the market is actually going up and all of that. But as a day trader, you are working more with 1 hour, and you are working more with 1 hour and 1 hour. You are working with more of 1 hour, 5 minutes, and 1 minute. So now we have seen this, that after this pullback, the market open was this pullback created today, and then the continuation. Am I going to take trade here? The answer is no. But there's something I will put you through, especially those of you who have not been trading. Okay? Now, especially those of you who have not been trading. And what is that thing called? It's now called, let's now go here. Price action, we have seen candlestick and chart. So candlestick, I've told you what candlestick is. It told you the history and, of course, message about the participant in the market, the buyers and the sellers, what they are doing and all of that. Now, it is multiple of candlestick that give birth to chart pattern. Now, candlestick single per every time. If it's 1 hour, if it's daily, if it's 2 hours, if it's 4 hours, and all of that, every candle you see represent that time period. Now, when they accumulate and form a movement, it can create a chart. And that's what you'd hear about. Majorly, you'll be hearing about double bottom, double top, and then so double bottom as chart, double bottom, double top, head and shoulder, inverse head and shoulder, and a lot of them. Example is this M pattern here. Look at it. This is a double top. So when you are trading, there are confluences you are checking now. If you look at this guy here, if this is a double top, most conservative trader now say double top have some content, right? The features of double top is it has an initial intention and rejected. Where it rejected to is tend to say it formed what they call neckline. And then it made the second attempt and failed, and then that become an M pattern. Most people wait for it to break the neckline before shorting the market. So such conservative trader now may not trade this guy until here. And now, when you short this market from here to here, your ideology is that the market should go to the next key level. And this is for people who are actually doing swing trading. So price action, candlestick. So we have different candlestick that some are for reversal, some are for continuation. And you talk about gravestone, doji, you talk about hammer, pin bar, and all of that. Inside bar, there are 3 white soldiers. There are many candlesticks that signify different things. But the fantastic aspect of this is that each of these candles should appear at a good point, maybe at the resistance level or at a key support level, as it were. So when double top was formed here, that gives you an idea of the potential reversal. But if it happens some places, then you may not give so much attention to it because it may be a misleading information. All right. So now, the next you have to understand is the market structure. This is the best. After price action, the next thing you must learn to understand very well is called market structure. Now, it is market structure that gives birth to trend. Remember, I would say price action has to do with candlestick, and candlestick is a single representation of graphical representation of action, bid and ask, which form different components of high, low, open and close, and then the combination of different candlestick form what we call chart pattern. And chart pattern have different interpretation and their functions or what they actually predict, as it were. So now, if that has been gotten, you are looking at the market structure. This is very important for everyone that must succeed in trading, irrespective of what you trade. Now, so market structure means the movement of the market, all right, by different swings. So we call it an impulsive and corrective. Impulsive. So market move by impulsive, corrective, impulsive, corrective, impulsive, corrective. So this impulsive and corrective are actually what form market structure. Now let's take this now. So at first of any market, it creates, so every market structure have 2 major components. And these components are, take note of it very quickly, there are 2 major components of every market structure. They are called high and low. So every market structure has this component. It has high and it has a low. Now, so each of these markets that have a high and a low, so we now have different trends. So I'm going to explain this vis-a-vis. So I'm going to explain them almost together. Okay? So we now have different trends. So we have 3 major trends, okay, that market structure give birth to. We have 3 major trends that market structure give birth to. Number 1, we have what we call uptrend, downtrend, and sideways, or what they call range band. Now, please take note. Most time I tell, in fact, either you're a professional, but especially beginner, avoid any trade that is ranging. It can deceive you. Example, look at when this market was doing. This is a range band. I love this setting. Now, why? Because it gives us all the 3 things we are looking for. Okay, so we have an uptrend. Okay, we have an uptrend. Then we have a downtrend. Then we have a sideways, which is called range band. Very fantastic. Now, the question you ask yourself is that, how do I know that the market is range? How do I know it's an uptrend? That's the presence of a high and a low. Now, a high form two type of high and low. It form a lower low. It form a higher high and a higher low. Take note. An uptrend form a higher low and a higher high, or a higher high and a higher low. While a downtrend form a lower high and a lower low. A lower high and a lower low. And but take note of this thing. A swing is not said to be valid if the consistent close of candle toward that direction is not up to minimum 3 close. For instance, if the market is going up now and is correcting, if you don't have at least 3 bearish candle in that same time frame, like 1, 2, 3, this is about 4, or at least 3 different bearish candle, then that means this is not a swing. You just have like 1 or 2 candle, and you make it as a swing. Why do you need to understand this? Because we are going to be using what we call Fibonacci retracement. You will get the wrong answer when you use Fibonacci retracement and it's not a valid swing that you are plotting it from. Then your result is going to be bad. So you can see why all of these things I'm mentioning are very, very, very important. So now let's look at it. There's some swing high and swing low that a textbook format, but you have to be very careful. And another thing is that we have advanced market structure, because advanced market structure is not like a textbook format. It has what we call external structure and internal structure, but we're not going to those things. Now, so let's quickly look at what you must pay attention to. How do I know that we are in uptrend? Okay, here, we're going to have something here. Let's quickly do this. Okay, so we're going to have something here. So see this point, and I go up here. This is an impulsive move, and it created a swing and corrective move, and then another impulsive move, and then another corrective move. Now, this is supposed to be a swing, yes, but that's an internal structure. This is the next one, right? And then see what happened. This actually was 1, 2, 3. Okay, yeah. So here, for instance, now this is where the double top was created. Okay, here we have about 2 candles. Okay, this is 1, 2, 3. So let me stop here. Okay, so let me stop here, wherever. So let me stop here. Now, this is the point. If you can master and settle down to understand this thing I just did now, the better for you. Now, listen very quickly. The presence of minimum, especially you are using lower time frame in your trade, the presence of 2 high and 2 low in a trend consolidate the strength of that trend. It validates the validity of that trend. Then the presence of 2 higher low and 2 lower low confirm the consolidation of the downtrend. Okay, so but now this is what happened. Those hearing on those one trading smart money concept, ICT, there's a common language in them. There's a common language in them that you always hear. And this is the language. Let me show you. This is the language. From this point, this is a low. So, but this low is the lowest for this time now. Though if you still go back, okay, that's the lowest. This is the lowest. And the high that created from this low is this one. So this is a swing high. So this is a swing low and this is a swing high. Assuming I want to draw a Fibonacci retracement to identify now, because some pullback can be a shallow pullback. Now this is a swing low and this is a swing high. Now, after the market pull back and it move back up, now this become a lower low and this become another low but higher than the previous one, which become a higher low, which confirm an uptrend, right? Now, this is the point here. If I want to draw what they call Fibonacci retracement, sorry, I'm not teaching you that, right? It's just to show an aha effect. Now, when do I see a shallow move? A shallow move is a kind of correction that come back to at least within 38% retracement of the move. That's a shallow move. After that is corrected, I may not wait for this structure to be broken. I can even enter and be targeting here that market may stop there. But if it didn't stop there, I continue to ride it up. Are you getting it now? So now, this is a swing low and this is a swing high. Then this become lower low when this low is recognized. Then I mark it. So you can see this I'm doing now is called market structure. Now, what happened? The market move up here, pull back and correct itself. The moment it surpasses this, it becomes what they call break of structure, BOS, because the structure has been broken and it continued. It moved up again here. It pulled back. In this pullback, it never got back to this point. Then I mark this now. This is another swing high. And then this is another swing low, which is higher than this guy. So I have another low, but higher than this. Then the market move again. Okay? The market move again. Now, you are going to say, what of this? This is an internal structure. This is a place people confused. Because this move up didn't get up to this. So it has not broken the structure. So the structure got broken. Where? When the market, it pulled back like this. Yes, fine, it pulled back. This is a high and this is a low. In going up, it pulled back. It's still part of this journey. Yes, this is a drop. This is a swing. But this become an internal structure. And so here is the real swing high. This low gave birth to this swing high. That was what broke this structure. So that means this guy is still valid, though this is an internal structure. So these are the challenge most of us have. These are an internal structure. Now the market now double top. So most time when they double top, some smart, sniper entry traders get into the market and then use their stop loss above the M pattern. But it is said to be that liquidity are usually available in those regions, but leave those aspects. Now, the first aspect I just want you guys to understand is this aspect of the market structure. And then once the market structure is well understood, then you can now identify what trend is. I've told you what trend is. Now, demand and supply zone is another thing. Now, one of the lovely things about demand and supply zone is that it helps you to find a region of trading for the time being. Region of trade for a time being, and then you can be in order. So you can see this guy right now, what he's doing. Okay? Remember, we have marked this, and then as simple as possible. Now, we now said that demand and supply zone is a point of like what they call maybe liquidity zone, all right? So buy side or sell side liquidity. So now liquidity zone is similar to what we call demand and supply zone. So here is called supply zone, which is a buy side liquidity. And here is like demand zone, which is like a sell-side liquidity. Several demand zones can be created almost to a different swing high or low. And when that swing high is created, like this is a swing low, now demand zone is here because this is the place that an impulsive move started happening. A place of impulsive, the origin of an impulsive move is said to be a demand zone. That an impulsive break for buying. Now, impulsive selling, where more selling pressure start coming, is said to be a supply zone. Now, it's said to be that sometimes market will be going down and return back to the source of the supply zone before confirming. That is, rejected from the supply zone. And that's one thing you want to do. So most time you want to trade from a supply zone to a demand zone or trade from a demand zone to a supply zone, which is very okay. And then you can have an idea and don't just stay in the market, because market can get to its supply zone or a demand zone and start turning back, not necessarily get to a major key level you are calculating. And that's why demand and supply zone is meant to be understood. Don't worry. We have a tool that will help you to identify those things. Trading is not difficult any longer like what people used to think if you can pay attention to maximize other tools. Now, I talk about liquidity. Now, liquidity is simple. Liquidity is said to be area of support and resistance where retail traders actually plot in stop losses. So supply zone, liquidity zones are different areas of or key levels where support and resistance lie. Number one, it can be a horizontal support or a diagonal support, like all this point that can be a liquidity. Now, it is said to be that market move from one liquidity to the other. Why? If the market was going up, it is said to be that the market, once certain liquidity are left behind, like this one, or this swing low and all of that, that the market is said to be returning back there and hunt everything before continuing to move up. Okay, now, so understand the concept. Now, what gives validity to liquidity are what we call order block. Order block. Now, order block is similar to demand zone, but the difference is this. Let me quickly show you. Order block is said to be the last selling or buying candle before an impulsive move start happening. The last selling or buying candle before an impulsive move start happening in the market. So how? Here, look at this candle here, this candle, this red candle. This guy now mitigate, grab the liquidity. So here is said to be a bullish order block. This last candle, a bullish order block. But for another block to be valid, it needs presence of fair value gap. That is, they call it imbalance. And so an imbalance to be valid too, I'm not teaching you SMC or smart money concept. These are just constant or concept or content or stuff like that from them. Now, for any order block to be valid, must have what they call fair value gap. Example, look at this. So after this first candle now, that was bullish, then come the second candle. The second candle move. The third candle could not come back to this end of this candle. That is a fair value gap. Look at it here. Let me show you very quickly. Okay, look at from this week now to the week of this down one here. This is said to be a fair value gap. Let me just extend it back so that you can see it properly. Can you see now? On top of the week of this and the bottom of the week of the third candle. So the presence of three candles is what gives birth to fair value gap. All right? The presence of two or three candles, the first candle creating a wick, either above or below, and the next candle engulf out, and the third candle pull back, but never meet the first candle, is said to be a fair value gap. And what happened? It's said to be a place that is yet to be mitigated, eventually will be mitigated in the future. Okay? Now, so that's why I always tell people, if you are carried away by some of those concepts alone, you may miss some trade, all right? But they are good though, but you may miss some trade. So imagine when this trade was going up here, you are waiting for this guy to return back here, and he never did. Now, so this order block here, it can to be a bullish order block. So both the place of order block and the fair value gap, all this place together, down here, join the fair value gap and everything, is what they call order flow. Okay, forget those concepts, but you just need to have an idea so that when we're using it, we're not just depending on them, you use it intermittently. So it's called order flow. So if this order flow, okay, market can come to an order flow. That's why sometimes you miss out of your trade. You are waiting for the fair value gap to be mitigated. The market has actually returned to the order flow. That is on top of the fair value gap. Now, if it's going to mitigate the fair value gap, I mostly enter into it at the wick of the candle the first candle that precedes the second candle where the gap was formed. And then my stop loss will be times 3 of the width. Like this, I will come and measure the width of the wick. Times 3 of it would be where, below that would be where my stop loss will be. Okay, so all of this thing I'm just showing to us is to have an idea so that when we are trading, and then even when we add some instrument, you now know what to look out for. You understand price action, you understand the market structure, and so that even when you are using any indicator, you can be more fervent and strategic in your market entry. Is that understood? So at this point in time, we now add 2 major indicators that you are going to use. It's called MACD, or, okay, so MACD or RSI, and okay, because I know any beginners will be able to use this, and flu trade. So it doesn't matter which instrument you are trading. So this is going to help you. So let's quickly go and enable these 2 instruments. Sometime, because you cannot use more than 2 instruments. If not, I always encourage people to use, they can use trend line too and all of that. But the essence of trend line is for you to understand the trend where you are. But if you understand the price action properly or market structure properly, you can tell yourself which trend are you actually in. Now, so you go to indicator and search for flu trade. So like food trade is written together. Look at it. You can make it, add it to your favorite. So flu trade will be added to your indicator. That's number 1. So once you add flu trade, it's going to give you something like this. Okay? Have you seen it now? It's going to give you something like this. Then the next you want to add is the MACD. So you go to MACD, you go to indicator and type MACD. MACD is named moving average, convergence, and divergence. Now, I may not have time to explain what I use MACD for 6 things. I've done a video about that. So people just use it to buy, just like how they use RSI for oversold and overbought. I use it more than that. So I use MACD for 16, as well as I use RSI for about 5 different things, not just overbought or oversold. So if you are limited to only overbought or oversold of RSI or MACD cross as the only thing, you may miss it. Now, so let me enable the MACD. So here is MACD. Lovely, right? Here is MACD. I love MACD, and if you understand your price action, it will help you a lot. So let's remove all this jargon that we have done. But remember, where you start from is to be able to do your key level on your trading view. And you can now see why I encourage people, all right, not to trade too many instruments. You can imagine if you are trading too many instruments, every time you just jump in. Yes, of course, you can trade like that though, if you understand what you are doing. But I don't have energy for all the time drawing. I just have my energy, set up my stuff. When I come, I know what to look out for, to trigger and all of that. Then when I do all this, we're now going to look at trading session. Okay? Trading session. Okay, let's go. Now, you see the chart down? Very clean, right? Now, this is 1 hour time frame. And I've told you, if you are a day trader, you're a scalper and all of that. You have no much business doing, but of course you have done your top-down analysis, and then 1 hour time frame is enough for you. 1 hour and 5 minutes time synchronization is enough for you. Now look at on 1 hour time frame. Look at ordinarily, like this is a demand zone coming from this where the impulsive move started from. The market actually returned back at first here, and then it moved up. So if you're on 1 hour time frame, you probably will have bought and you'll be struggling here. This is a range market. Perhaps you know what to do per time, and then market until eventually move up. These are the places where people miss the market. One of the lovely things about the MACD too, what it does is that when you see your MACD refuse to leave each other too much, then just avoid such market because that market is not trending. Now, the content of MACD is simple, and I will explain to you. The three major content of MACD are very simple to understand. One, we have the histogram. The histogram measures volumes that are available either for selling pressure or a buy pressure. Now, most time, I change my MACD to like, okay, sorry. I change my MACD sometime. Okay. All right. So I change my MACD sometime to like MT5 pattern, but don't change yours. Just leave it like that. It will be easy for you. The histogram is volume representation. All right. This guy, this blue line is the MACD line. Why this orange or you, I don't know what to call it. It's the signal line. Now, they are actually moving averages, so you need to understand them. They are actually moving averages, and I'll show you. Now, when the moving average is crossing, you equally want to see some selling pressure. It's a combination. That's why they call it moving averages, convergence, divergence. And I'll give you the interpretation of this convergence, divergence. There will be some time price movement and the moving average will align. That means there's a convergence. They are saying the same thing. There will be some time they will say different things, but you want to now believe in the one of MACD because the MACD have some hidden volumes. Now listen, sometime when you are trading, all right, when you are trading, when you notice some big volume and market refuse to move, right? There's a big volume, market refuse to move, and it's still selling. A very sudden volume come, but they're still selling. And then volume reduce, right? Volume reduce and is down buying. Note that some manipulation is about to come in and all of that. But let's not go deeper on all of those concepts. So now look at the MACD cross here. So I'm sure after now you are going to sit down with this video. So look at the MACD cross here. And look at another wonderful thing here. So now when MACD is crossing, you see the volume sell pressure coming. Now, when more red is redder and longer it is, this is long. That's the more selling pressure of that. Now, when the guys start getting fainted, it is said to be that the market is now about to, maybe a pullback or at the same time, a reversal about to set in. But while this was pulling back, it can do normal retracement. Now, after the retracement, so until the MACD line itself about to cross the signal line above again, and then you can see, but listen, not all the time is going to give you this because that's one of the things most of us misunderstood. It will not give you this all the time. So this should be confirmation. Now, is it only this? No. Now, for the fact that you have seen this, the confirmation for you to find an entry, the confirmation for you to find an entry is now you are looking at your price action. Look at it now. So look at where it actually crossed. But before it crossed, because one thing in MACD, the MACD line has started bending, right? It started bending at this first move. But in the trading, where I said the strategy I give to you to trade is support and resistance strategy. For the fact that that happened, you see that the market still went up. And because MACD has refused to cross, then finally, so some sniper entry traders, what they do is that because first attempt, the MACD was already bending, and then second attempt, it crosses. That's actually sell, right? Now, look at it. Look at it here. There was a small cross here. You may be tempted to sell, but if you understand your price action, you may not sell. Look at another one here, right? So look at the cross. Now, why am I not selling here? I will explain to you very simple. Even though you have MACD, pay attention to this, what we call zero line. Let me open it, guys. You can see. Okay, there is a zero line. Let me mark it for you. See this zero line? I'm going to put a line there, and then you can see it more better. So line, okay, and I can actually make it to be red, even thicker, okay, or more thicker, okay. Okay, so you see that there's a line. Can you see? There's a line in between the histogram. Now, when the MACD had actually crossed above the zero line, it tends to be an uptrend. It validates an uptrend. Now, it will be pulling back and even cross down here. You are looking at your price action and your histogram. That is to say, these are just major pullback. Now, so because when you sell off without taking note, and sometimes when it returns back to the zero, it tends to take off again. So you pay attention to all of those things, and so that you don't miss out on some major market. Because the MACD will return back to the zero line and then jump back again. Then that's another thing. Or especially when that's happening, see this your what's it called? This your guy, support, demand and supply zone, now confirming. And I will say something. When demand zone or supply zone painted the second one, it confirmed the strength of that trend. Like this now. We have one here. Another one is confirmed here. That's a confirmation of this trend. That means we're still going to go up. Of course, your target was even this key level. And then you have the demand zone ahead. That makes a lot of sense. Now, sometime when you have some liquidity before demand zone, it is said to be that the market need to come and grab them before taking a return. Okay, this is very simple. Now, if I look at the market, so am I taking trade here? No, unfortunately, no, because you are not a swing trader. I haven't checked this now, and I have marked this. For instance, remember we say when we come today, we saw that the market was bullish. Now, how do I know? I've seen of course, it's an uptrend. And for the fact that we are in uptrend, are we bullish for the day? That's what you are looking for. Yes, you are find out here, and then that's why you want to take a trade there. So you go back to 5 minutes. Okay, so if we get back to 5 minutes, see what we are going to see. Now, in the 5 minute too, you now have series of demand zone, of course, that was created. Most time when I come in, depending on when you come in, I love to go back to 1 minute time frame so that I can see a market structure shift and then find appropriate entry. So going back to 1 minute to find the market structure shift, it's an amazing strategy. Or actually, if I go too much advanced with that, you are going to use your support and resistance. But the beginning of the beginning is simple. Okay, I mean, to be too technical for you on that. Forget about that, so that I won't complicate issues for you. Let's go this way. Okay, so now let's go this way. You came today and met the market. No, you didn't meet the market here. So what you want to do is called demand and supply strategy. Now, let's take our MACD to actually look at some things. And take note, I'm only doing this today. I'm only doing this today. On Thursday, I'm not coming back here. So whoever that was thrown around, look at on your lower time frame. You see that we're in uptrend, right? And you see this thing I just explained to you about MACD. Now, coming down here, MACD crosses here, which confirm to you. Now, this is a simple thing you were doing. As at the time you came, market was moving. I say use support and resistance strategy to trade. So if that is the case, market was here. Don't always enter trade when a candle has not been closed. So what to do, very simple, is that market is moving up, right? Yes. Then you go to the impulsive move of this market, which you find here, the wick of this candle, and then you mark it out, which is a swing high, right? So you want a correction, right? You want a correction. After the correction is actually now finding an entry, which usually is sniper entry. But for conservative trader, when they mark this, they want the market to pull back and equally break this structure before they find an entry, which is here. But for me, I may not wait for that. As the market pull back and then look at multiple weeks and the market start engulfing, it's very much likely that your entry will be anywhere here. But take note, where should be your stop loss? Your stop loss is going to be below the recent swing low, which means you are doing a trade like this, which we are going to do after this meeting right now. After this episode, I'm just trying to use one bird to kill. This is the place we talk about your management, your risk management, money management. Now, let's go. We said your trade, your stop loss is 1:2. Now, let's go. So your stop loss is below this swing low. And 1:2, this is already 1:3. Remember your escapa or whichever thing you are doing. 1:2. Let's go. Yeah, you may say, can I not do more than that? I'll tell you how you do more than that. But so 1:2, let's look at it. How many pips is this? Your stop loss is 9.9 pips. Your take profit is 19.8 pips. So this is currency instrument. Now remember what we talk about calculation. So what's the lot size I'm using? Okay, I'm using maybe let's say 0.1. 0.1. So 0.1, it means if you hit my stop loss, I'm going to lose 9.9, which is cool, within what we calculated from the beginning. Now, if I win, I'm going to make $19. Very simple. 19 point something dollar. Very simple. And that is done. Now, when I'm entering sometime, if I see that what I want to use, maybe I want to say, okay, I can afford to let $10 go for this. So $10, how many lot size is this? 9.9, let's say 10. So 0.02 or 0.03 times 10 or times 9, is it 9? Okay, times 10, you calculate it. Then you can now divide your trade into like 3 or 4. That's the best way to now be able to get more risk-reward ratio. So when you open like 2 or 3 positions, then the trade is going on. The first one you enter, or anyone, you set the take profit, actually 1:2. The other one or 2, you left it open, but you put your stop loss on all of them. So now that is the strategy you are supposed to use. Now the trade continue to go, and the first take profit is taken, and the market continue to go, no problem. You now trail your stop loss over again. You just move it up, and then the stop loss, after the take profit is done, then and the market start moving, you adjust the stop loss above your entry. So you adjust your stop loss above your entry. Then market continue to move and it has not stopped, because that's how you are trailing it. You can see that you are just adjusting, and your stop loss this time around is going to be below this swing low here, down here, and you continue. So that's how you trail it, because why? You already have a mindset that look at where the market is supposed to come to. Okay, so you can see this guy now, SND, GBP, SND, and that's the simple thing you must always do, to be in charge of your trade. Does that make sense? So if I want to do others now, so I trade more of I trade more of commodity and all of that, derivatives, rather than currency. Currency does not give enough money, okay? Currency does not give enough money, and then it will have given you so much kind time and waste of time to analyze the market. Just like look at euro that I sold down, and now see what it's still doing again, even though it's bearish. For anyone who do not have his understanding, will have, right, will have jumped out of Euro USD that I short. Now look at, since this is daily time frame, okay? So you can see different demand zone up here. Double top was what Euro USD did, and then, but though we are at the bottom now because it's like ranging as it were. But for the fact that you are now ranging or possibly trying to find a way up does not mean that the market, you cannot find a sell position for the day. And that's exactly what happened here and all of that. So if we go to, because I'm on position on Euro USD, I short a trade. So after I've short a trade, he jump up again and doing what it's doing now. And a lot will have said, okay, it's like the market, so you don't need, I've entered my trade, perhaps somewhere here or so, and my stop loss is above somewhere there. No, that whatever it's doing is not my business until eventually may deliver to what I'm looking for, or perhaps just come down to this liquidity and grab it, or return back to this as much as possible. And that's one of the things you are doing when you are trading. See that the markets, I may not be able to start drawing the key level for this one, but you can see at the markets, this is a high, this is a low, this is a high, this is a low, this is a high. So another low created, you cannot call this one high. You don't have consistent 3 candles close without towards that direction, but this is a high, this is a low, this is a low and a high, then a low, or until we're able to close all this region and all of that. So maybe the market, if you grab this liquidity, may bounce back, whichever way. And that is why when you are entering such market, so imagine when you wake up, look at what happened. This is Euro USD. When it opened, it first went up, and then before finding it way down, right? And this is 4-hour time frame. So you can look at it to say, okay, if this liquidity is grabbed, it may bounce back. Or if you grab the liquidity and continue to sell, then you are looking at those points. All those points are simple and easy to see, right? I have been on oil since yesterday. And if you see what oil did, it was just doing what it was doing, and then eventually continue to buy for me. And if I was doing Jamboree, move from this instrument to this instrument, I would have missed, or I would have even closed it out of fear. I say, my God, the market is coming back to my entry. What's happening? No. Gold, I was on it since yesterday, and I did not close the trade. And those are the things I actually have to. So I'm going to give you a few minutes now to select 2 major instruments. Yes. And do a top-down analysis on them with the key levels. So, okay, pick gold. Even though gold were still going up. So it died yesterday. A lot of people must have run out. So pick gold. Okay, for those of you who have not been trading, so you can pick Euro USD. Thank God I didn't even do the analysis. Euro USD and GBP USD to draw the key level, right? Draw the key level of this Euro USD, GBP USD, and then tell us possible trend that any of them is actually doing right now. I think Bitcoin is supposed to have done since and start, okay, start dump and then start bouncing. I think I was in a position, was I? Okay, so let's look at MACD. Okay, it's about to cross 15 minutes. So you can see what Bitcoin 2 did. This is contraction, expansion, and delivery. So you can see now it's going to 96,300 and something. Yeah, that's where Bitcoin is going to again now. So for somebody who understands what we have said, look at your mark. This is already giving you signal about to cross and all of that. And sometime I told you, I said, while you are trading, to find an entry opportunity, 15 minutes does not give you a call. 15 minutes is actually not for scalping or day trading, it's for intraday trading. That is a trade you can enter and may eventually enter the following day. That's what your 15 minutes is meant for. Okay? Now you can see something that has happened here now on Euro USD. Look at something here, a lower low, and then what happened here? A higher low. So this is what we call divergence. This is a bullish divergence. While the guy was going up, this was coming down. This is a bullish divergence. You can see when we go to 15 minutes, that is contraction, expansion, and all of that. How did he actually contrast? Look at it here. So if you will pick it here, which is the support and resistance, which is what SMC trader or ICT trader told you about liquidity graph. So now for a sniper entry trader and scalper, after he has gotten this now, that this guy, so that's what I wanted to say. After he has gotten this now, that this guy actually now push out to liquidate and return back to the region. So when it come back to the region is the entry. The person is not going to enter here. It perhaps can go to 1 minute, right? So you can see in that 1 minute, look at, see what has happened. In that 1 minute, you have seen the grab out and then return to the region. This is the entry point of this fellow because this is a high and this is a low, another high and a low. So this is the entry point. And look at the first profit target is this one, right? Right? That's the first profit target is this one. So let's look at it. How many percent? Okay, about 0.30 something percent. So if it's a Forex, you are going to see how many pips that will have been. And then that's the take profit and stop loss is below this point. And then, so when the market continues to ride what's going to ride, you want it crosses this point and actually consolidate on it and continue. Then that means the other position you open, you want to hold it and continue to follow it up. Okay, so go and do that. I'll give you like 15 minutes to pick two instruments and do the top-down analysis, right? Well, with your markouts, key levels, then so that we can find a trade. At least we can find trade towards New York session, as it were. Okay, so fortunately, you are the only one, so you can do that right now. So let me stop the recording.